The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit futuremoneytrends.com/gold. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with Reggie Middleton. He's an American financial analyst who is the founder of Verification. He has predicted the U.S. housing bubble back in 2007. And my goodness, there are some YouTube videos that I just watched. He had a major call on Apple, major call on Bear Stearns, major call in Lehman Brothers, major call with Goldman Sachs. This guy gets it. Eric Sprott, a billionaire and founder of Sprott Asset Management, referred to his research as some of the most accurate and detailed information he's ever read. Reggie, thank you so much for joining us today.
You're welcome.
Reggie, before I get into all my questions about Bitcoin and investments and some of the more things that the audience is probably definitely interested in, I know everyone wants to know, first off, what are your thoughts on the market right now? As someone who did see the last crisis coming, is this the next big crisis in 2016?
No, it's not the next big crisis. This is a continuation of the last crisis, which never got to play itself out fully. The market was at the top of a peak of a bubble. The bubble popped, and central banks around the world gathered in a concerted effort to elevate risky assets above what fundamentals would have them be at. In other words, they tried to reflate a burst bubble, and they did, and they elevated the price of risky assets. Unfortunately, the fundamental values and the economics behind these prices did not support the prices themselves. So basically, XYZ Rigid was selling $400 with a value of, say, $30 or $40. The market caught up to these prices. The prices collapsed down to $50, $40, $30, even $20. And the powers that be, the concerted central banks, as in the Federal Reserve, ECB, Bank of England, Bank of Japan, etc., worked together to lift prices up using machinations and arcane devices such as negative interest rates and zero interest rate policy and QE to push prices up by forcing liquidity into the market and basically holding a gun to those investors' head who need income by giving them no income in income-producing assets, forcing them to go into risky assets, stocks, etc. That drove prices up. And now that the prices have been up and going up for a while without the fundamental values to support said prices and the economic strength behind it, they're now falling back down. Gravity is coming to the forefront. And it may seem like two different occurrences, but in actuality, it's simply paying the piper.
And that makes a lot of sense because a lot of people, their big complaint in this economy is that they never felt like the recession ended, even though the mainstream media would say, and the mainstream economists would say that it officially ended in June of 2009. Your average day American feels like we're still in that recession, which, as you're noting, we essentially are. So will 2016 or even the next 18 months, will it get back into that full-blown crisis mode like we had in the fall and winter of 2008? I guess that's what I'm really pointing to with the commodities in full-blown collapse and now the stock market indexes globally melting down.
Well, so I was never in the business of predicting the future. What I did was I studied the past and I fervently analyzed the present. I think the regulatory bodies and a lot of the financial structures are better prepared to handle entities that are about to go bust. because they have learned to put much of the onus on the investors that's invested in these companies to capitalize them versus letting the taxpayer and the state, the public, and basically you and I, take the brunt of the collapse of a large financial institution, which is fair. In the 2008 collapse, there's a saying that became popular. You privatize profits and socialize losses. So basically, when everything is going well, it's a private corporation, they get their bonuses. And, when the due hits the fan blades and the brown stuff splatters, and all of a sudden it's a public issue and the taxpayer has to come in. Now, once investors truly realize that they have to bear the risk of their investments and not just the rewards, that capital, that money will be priced much more efficiently and most likely much more extensively, which will automatically curtail the size of the bank. These banks get to multi-trillion dollars in assets under management, assets on the balance sheet, simply because that $1 trillion didn't cost what it should have. So if you're not paying what the money actually costs, you of course are going to get more of it. When you have to pay a legitimate market price for the capital, you will be very careful in the capital that you employ. Or those who do not have a legitimate business model in the eyes of a real investor who takes a look at profits and losses, rewards and risks, will not give the capital to the business in the first place.
As this sorts itself out, where are some of the safer places for people to be right now? Is it a mix of cash and gold? Do you like getting money out of the banking sector? Is Bitcoin too speculative at this point for a safe play? Or I saw your background. I mean, do you like whole life insurance policies? People like cash value. To get the money out of the banking system.
Well, that's a complicated, complex question. Not so much I'm ready to ask, but in order to answer what is the safest, you have to understand the risk profile of the person who asking the question. Mm-hmm. So what would be safe for you may not be safe for me, which would be ultra safe for somebody else. In general, expect a lot of volatility in the banking sector. Expect some of the weaker capitalized banks or the more speculative banks to again face failure. And the larger banks will be protected at least up to FDIC and SIPC maximums. Outside of that, the questions, the answer to those questions are actually very, very individual in nature. And that's a point I actually want to emphasize. A lot of people ask, for instance, someone asked me this morning a question, what would be the best investment? That's like saying, how do I get to a city? And of course, the next question would be which city? And it depends on which city you're going to. So without knowing the city that you're going to, I can't give you directions to a city. Without knowing your individual specific situation and what your goals are, nobody can give you an honest answer to that question.
Do you consider gold safe for yourself? I mean, I guess without knowing an individual's risk tolerance and what they define as safety or volatility, I mean, do you consider things like gold and cash value life insurance as safe?
Cash value life insurance is an inefficient investment from our perspective. Number one, you're paying a death benefit feature, which as a pure investing doesn't come in very handy, particularly for the insured. Best case scenario or the best payout case scenario, you're not there to cash out on it. And as a savings vehicle, it's loaded with expenses that you wouldn't have to pay if you simply saved and invested the money yourself. Life insurance is best for estate planning when you can take advantage of the payout feature. And that is a relatively advanced way of putting a product together, because then you have estate tax to deal with, et cetera, et cetera. The gold and precious metals are not my cup of tea in terms of long-term savings, but they do come into play, especially those people who have large portfolios and want certain parts of the portfolio to have an off-the-book style value.
Reggie, what do you see in Bitcoin that makes it a game changer in world finance?
Well, it's a totally new platform. It's a totally new way of engaging with others. Bitcoin in the media has gotten a lot of attention as a digital currency, as a speculative investment. But that's not what Bitcoin is from my perspective. To give you an analogy, it's like saying, how is the internet special in terms of finance? Most people don't think of the internet as finance, but the internet is part and parcel of finance, telecommunication, media, and everyday life. Bitcoin is a protocol-driven platform, just like the internet is a protocol-driven platform. The internet uses TCP/IP, which is a protocol, internet protocol, to send bits of data and packets of data back and forth in a decentralized fashion. Bitcoin uses the Bitcoin protocol to send value back and forth in a consensus-driven, decentralized fashion that is not controlled by any single individual entity. So think of a platform like the internet where you can exchange value and you can come to the truth or a decision without being beholden to any major entity such as the Federal Reserve Bank or a regulator or a particular government. And on this platform, we have a fairly rich programming environment where you can build other applications such as digital currency, which is the Bitcoin a lot of people are familiar with, or identity management, or file storage, or securities trading platform, or securities clearing platform, or you can fill in the blank. That's what Bitcoin is.
Yeah, how smart do you think, or excuse me, how soon do you think smart contracts will become an everyday thing in our lives?
I'd say definitely within a decade for an everyday scenario, very similar to the internet. And the early ones are coming out now. We have smart contracts that are usable in trading as we speak. Go to the website, veritasium.com, and download the prototype Java client and make a trade with Bitcoin using a smart contract that represents a peer-to-peer swap. And you can trade, almost any value above 45,000 tickers. Go long IBM, short Facebook, long gold, short euro, et cetera, et cetera, et cetera.
It's incredible. Do you think Wall Street getting involved in Bitcoin is positive, or is there something nefarious with JP Morgan's Blythe Masters making a startup involving blockchain technology?
It's just the natural state of things. That's like AT&T getting involved in the internet back in the 1990s. It's bound to happen. And the first players usually go in the wrong direction because instead of attempting to embrace the technology as a new paradigm, they're attempting to protect their cash cow and their legacy business, which very, very rarely, if never, efficiently uses this technology. To give it a good example, in 1915, AT&T discovered that radio-driven cell phones, radio-driven phones, were a viable technology, but they decided not to pursue it because they didn't want to damage their monopolistic grasp on the telephone business. That's 180 something years ago. Now, if you fast forward, 40 years later, you had a similar situation with Bell Labs, who a Bell Lab employee actually patented cellular technology, and but Bell Labs didn't use this technology. Bell Labs didn't use this technology because they hired a consultant which analyzed the available potential market, and they came up with 100,000 users as a maximum. This was in the 1940s. You fast forward to 2014, and there were 7.5 billion cellular accounts in use. That's actually more cellular accounts in use than there are people on the planet. So you can see 100,000 and 7.5 billion is a pretty big difference.
Yeah. When you look at the economy and then you look at technology, does the technology expansion and rate of growth, does that make you an optimist?
It makes me optimistic in technological growth, and usually the expansive growth of technology usually runs part and parcel with an increase in efficiency. Now, of course, when you have this increase in efficiency, you usually have a decrease in the amount of legacy labor that is used, because basically people who do a lot of manual jobs or put out of work. Now, that's negative for those who do those jobs, who have those jobs. The positive is the businesses and those who consume the products from those businesses get the benefit from an increase in efficiency, where the businesses usually reap it in a greater profit, and those who use the products get to reap it in either less expensive products or higher performing products. For those who are put out of work, the key is to relearn the key is for the labor force that was put out of work to learn the new paradigm in technology and application. So if you were once a coal miner and say solar energy started taking over, you could be put out of work as a coal miner, but the key is to train and learn how to build, say, solar panels or solar connectivity, widgets, et cetera, et cetera.
Reggie, last question on oil. It's a really big deal right now. It's essentially crashing, and you've got Russia, you've got the U.S., specifically in Texas and North Dakota, and then Saudi Arabia. Who is the biggest loser from this fall in oil, and what do you think it's going to take to turn the price around?
It's hard for me to tell. I'm not an oil specialist. I call any comment as a layperson. But as a layperson, I would think that those great investors in the fracking technology are probably the biggest losers, because they have the highest cost structure in comparison to the more traditional drillers, say in Texas, etc. And those in Texas, Oklahoma, etc., and those in the Arab states and Arab nations such as Saudi Arabia, who I believe have one of the lowest, if not the lowest cost basis structures. But all in all, the price is very low, and I don't see from a fundamental perspective, as far as I know, the price increasing significantly, because I doubt if demand's going to increase if we're going into recessionary times again. And on top of it, we probably have a decent supply of oil. As you probably know, Aramco, which is the Saudi-owned and the state-owned oil company, the largest in the world, is putting indications out that they're going public. This is a multi-trillion-dollar offering. It's about 5 to 7 times the size of Apple. And Apple is the largest publicly owned company in the world. Whenever the experts and those in the know are willing to sell, you should be the one selling as well. You never buy when experts are selling, because the experts have inside information that the average person doesn't. If they're willing to sell their crown jewel oil assets, I would think the writing's on the wall, particularly when they're willing to sell these assets in oils that are record low. Or inflation-adjusted record low, should I say.
That's a great point. Well, Reggie, Middleton, you're certainly a deep thinker. If somebody would like to reach out to you or find you, where's the best place for them to go? And then what's your YouTube channel as well?
The YouTube is, I don't have that memorized, because I rarely give up YouTube. People usually find it by searching.
No worries.
But if you do a search for Reggie Middleton on YouTube, you should be able to find the channel. At Reggie Middleton, it's my Twitter handle. My website is Veritasium, VERITASEUM.com, for the website, which has its own dedicated research blog. And you can always reach out to me via email as well, at Reggie at Veritasium.com.